show's sponsors.
Welcome back, American Family Radio, Financial Issues. I'm Dan Celia. We are going to get back to the phones. David was talking about my stock market issue there, my picks there on the stock market. So, David, I mean, really the thing is that, listen, if anybody out there has been listening to me for any length of time and has criticized me, a whole lot of people out there have criticized my position on cash. So if you're a partner with me on the website, I hope that you've gone to my asset allocation models and you take a look at how much cash we have, which, by the way, are all those asset allocation models are about to change in the next week. So make sure you check back with them. But I'll put an alert out to everybody letting you know when they changed. I have big cash positions. The reason I have big cash positions is because we've got to protect on the downside. So I wrote about this in my newsletter this week, and basically what I said is that you have to look at it. If you got 50% cash and the market goes up 15%, then you're up 7.5%. Are you going to be happy with that and happy with the fact that you're protecting half your portfolio for the downturn? If you're not, then go ahead and get fully invested. But you need to understand that you got to be smart enough to get out right before the crash. You won't be, because nobody is. So you'll end up riding now all of your money down to the bottom. And then you'll be waiting 10 years, 6 years, whatever it is, for it to come back up to where it's a break-even point. Then you're going to wait another 4 years to where you have the same profit that you had before the crash. And it's not that you've lost that money and have to wait. It's that you lost all the time. You could potentially lose 10 years of time that you would have done better in the money market account for 10 years. So that's the piece that people don't understand and don't get. So my position is one of mathematics. My position is that there will be a dramatic correction and another recession that is going to be dramatic. And I only say that, could it be avoided? Yes, but there's no signs of us taking the necessary steps to avoid it. So in the absence of those signs that we are moving to try to avoid it, it's going to happen. I just don't know when. I wish I did. I don't. But I will say this, we're closer now than we've ever been, because I have firmly of the belief, everybody knows, the GDP number is a joke, sad to say, right now, because I don't believe in the GDP number. I don't believe that we have a $16.5 trillion economy, GDP. I don't believe we do. I think it depends upon the inflation factor that you use. Based on the inflation factor that the Department of Commerce uses, we don't, in my opinion. I think it's all an illusion. It's not a conspiracy theory. It's just math. And the example of that math, without getting too deep into the weeds, I probably should write something on it, is there's two different inflation factors that are being used. I've talked about this before, but let me go through it again. The inflation factor that is used by the general public, by all the government and the government agencies, is CPI, Consumer Price Index, as a measure of inflation. And that is the inflation factor that is used. The inflation factor that's used by the Department of Commerce is called a GDP deflator. GDP deflator. It's a whole different factor. And over the last 30 years or so, the GDP deflator has been lower than the CPI, not by much. I think on average it's been like 0.15% or something. But when you compound that over 30 years, you get a very different number. And the GDP deflator means that the way that works is the Commerce Department can change what's in this basket of goods by which it measures inflation. They can change. So let's say they have oil in there, which they don't, never will. But let's just say they had oil in there. They can decide, you know what, oil's really going up. Let's take that out. Let's put in, let's replace it with coffee because coffee hasn't gone up. As a matter of fact, coffee has gone down. They can do that. It's a ridiculous. So if you just use CPI, and I don't believe CPI is correct either, by the way, but I'm just saying, if you use CPI to calculate GDP growth over the last 30-some years, if you use that number, then our GDP is about $13 trillion of this nation. It's deception. So I'm not saying it's $13 trillion. I'm just saying it's not $16 trillion, and I don't know what it is because you can't believe anything. So when you look at the math of income coming in, of taxation, productivity, wages, poverty rates, unemployment, underemployed, those dropping out of the workforce, when you look at all of those things, it is literally an impossibility that we could be in any kind of sustainable recovery. And it's literally impossible based on those trends that at some point in time, something's got to give. And all the while, we're taking on $17 trillion worth of debt and rising, which is a huge percentage of GDP if you use the 16.6 trillion GDP. If you use the 13 trillion, according to CPI GDP, we're done. We're already going to go over the cliff. So I know that's more than you bargained for, David, but I think it's important that we all try to understand. And I say that because I don't want people to say, well, I just think it's going to crash. No, it's not. Or maybe you want it to crash because you don't like Obama, so you want it to crash. It's nothing like that. I'm just looking at the numbers. And where nobody else is willing to look at the economy, they're looking at the markets. I'm looking at the economy. I've never looked at the markets because the markets are supposed to be a reflection of the economy, not the other way around. So, I just think that it is totally unsustainable. There's going to be a move. And all I'm saying is if you've worked hard, if you're 55, 57 years old, and you've worked hard to accumulate some wealth in your 401ks, IRAs that are going to use, you have to, at some point in time now, you have to start taking a position of at least 40 or 50% in cash so that you can protect on the downside. If you've got some good solid stocks and you want to keep those good solid stocks, that is fine. And if you got 10 years, 8 to 10 years, that is fine. Because even in a crash that we're likely to have, ExxonMobil, Valero, some of the other big name stocks, International Paper, Procter & Gamble, some of those big companies, they're going to recover relatively quick. So keep them. I'm okay with it. But you've got to have a strong cash position so you don't lose anything. Because if you have a strong cash position, the market crashes, right? You can do two things. One is you have some cash to buy into those bad positions that are now low. That's number one. The other thing is if you need money to supplement your income and you're using the same account for that money, you now can take the money to supplement your income out of cash. And hopefully you'll have enough to do it to last you long enough for your rest of your portfolio to recover. So you're not forced to sell some of those positions in a bad market in order to supplement your income. And it's just good, practical common sense. And we need to just be very, very careful. And I think the time is coming where we are getting closer and closer to the markets realizing that the economy is not strong enough to sustain this continued growth, since the growth has come from cheap money being poured into the markets by the Fed. And when that drug gets taken away, there will be withdrawal. There has to be. The question is, what kind of impact is it going to have on the economy? I think the economy is already very, very bad. So Can it get worse? Sure, it can. We can start seeing more people get laid off again. But that's my position, David, and I know that's more than you bargained for. But hopefully that gives you some insights. And I'm going to go to the next call. I may be wrong about this, but I think it's Rocky from Virginia. I've lost my software here. I got to reboot. Go ahead, Rocky.
Hi, good morning. Thank you for taking my call. I've listened to, I came along with your ministry a few years ago, and I moved out of a family of mutual funds into a Roth IRA with the Values First investors. I'm in the aggressive fund. And I've been keeping up with I do partner with your ministry, so I've gotten your email alerts. And I have about maybe $1,000 there, and I'm coming up on 51 years old. And I was looking at, your asset allocation, about 50% cash. I'm just wondering, do you recommend into a different portfolio with Values First, or should I just move it out and maybe follow some of the stock picks?
Yeah, I would just follow the stock picks and get out. I would sell the aggressive portfolio right now. As a matter of fact, it's not just me, by the way. There was just research out this morning from, I don't know, I don't remember. Well, I didn't print it. I don't know whether it was J.P. Morgan or Goldman Sachs, but more research talking about emerging markets and aggressive portfolios because of bond yields and other things are going to get hurt. And I would get out. I think that would be a good position for you right now, Rocky, to get out of that and altogether and start thinking about following my asset allocation models a little bit closer.
Still do that in a Roth IRA?
Yes. Oh, absolutely. Yeah, absolutely. Yeah, still do that in a Roth IRA. I wouldn't change that. Yeah, definitely.
Okay. All right. Well, I really appreciate your time and your ministry. Thank you.
Thank you, Rocky. I appreciate that. Thank you for the encouragement. Let's go to Pamela in Louisiana. Hey, Pamela. Okay, let me go to William. William in Mississippi. Hey, William.
Dan?
Yes, sir.
Yeah, William in Columbus.
Oh, Columbus. Okay.
Listen, Columbus, you become a hobby and a habit. We love you, brother, and we support you. I want to ask you some questions on your views on ethical issues, moral, ethical, biblical issues, or companies more specifically. I mean, companies like, say, Disney or a company that sells like wine or alcohol or beer. And I asked this question. I ran across an article the other day, and it's about a company called Enjoy. And what they do is they produce that electronic cigarette that's supposed to help people to try to quit smoking. What's your view on that? Is that, I mean, they look like they have a bright future, but, I mean, I'm trying to stay true to your list and what you've got. But how do you view companies like that? I mean, where does the biblical, moral, ethical issues break down for you?
So here's where they break down for me, William. That's a great question. Excuse me. They break down for me in that what is a company? Two things. One is what is a company profiting by? For instance, a pharmaceutical company that is making a considerable amount of profit or any profit whatsoever on the abortion pill, or maybe a pharmaceutical company that is engaging in embryonic stem cell research. That would be, they're making profit. That's going to their bottom line. They are profiting from that. A company like Best Buy's or Apple that is profiting by pornography, that is, that's not a company I'd want to own. A company like, I don't even have to pick a company. I just say a Fortune 100 company, a big company who has employees that are engaging in activities that would be immoral or unbiblical. If I didn't buy that company, I wouldn't buy any companies, because we all, even ministries, have employees that are probably doing the wrong thing and we don't know what they are. But I look at what they are profiting from and what they are doing with their profit. So if the corporation like Home Depot is spending millions of dollars supporting gay marriage, for instance, That's my money. In other words, if I own Home Depot, that's my money as a stockholder that they are using for things that are against what I believe are God's values. So I wouldn't buy that company. So I break it down like that. It's just that simple. It takes an awful lot of work to do the research on that and get that stuff, but that's how I do it. Hope that helps you, William. Thank you for your support, brother. Folks, 866-300-9298. We'll be right back.